Well, the alternative, I guess, was political suicide. I mean, the problem was the government, mainly under, prior to Nixon coming on board, a lot of it was under Lyndon Johnson. But during the 1960s, you had, the war on poverty, Great Society, Vietnam, the moon mission. So we spent a lot of money, and we issued a lot of debt. We didn't have gold about it, and so we came to an inflection point where either we needed to deflate, devalue, or default. And so in order to devalue or deflate rather the bubble, we would have had to have prices coming way down to meet the gold price. Alternatively, we could massively devalue the dollar and make gold. Nixon tried devaluation, but it wasn't enough because he only devalued a little bit. But it would have been very politically embarrassing to substantially devalue the dollar. So they basically chose defaulting on the obligations. Remember, Federal Reserve notes were obligations to pay gold that we did not have, right? Because we created too many notes. It's like if you have a checking account and you write a bunch of checks, but that exceed your balance, right? These checks are going to bounce if any people try to cash them. And we had issued a lot more Federal Reserve notes than we had dollars to back them up because the Federal Reserve notes were IOUs for gold, right? That, people were loaning us their gold. And so rather than massive cuts to government spending that would have been required, a deflation of prices coming down, and defaults and bankruptcies, a lot of things would have had to happen. And Nixon took the easy way out. And, we did have a big inflation that followed. Anyway, we had a lot of inflation. That's why we had the price increases in the 1970s, because Nixon, made the choice that he did. And if you remember, or know about the 1970s, the dollar lost about 2/3 of its value versus the Deutschmark, the yen, the Swiss franc, but it lost even more relative to gold. And it went from $35 an ounce to $850. But oil prices went from $3 a barrel to $30 a barrel. It's a tenfold increase. But oil prices didn't really go up. The dollar went down. When we were giving OPEC $3 to buy a barrel of oil, we were giving them $3 that were backed by gold, that were redeemable in gold. But when we were giving them $30, we were just giving them paper. They couldn't get anything. So it was politically expedient for Richard Nixon to take that path.
Sure.
And unfortunately, that path became available to him in the Johnson administration because that's where the president was given the authority to do that under Johnson. And in fact, my father is one of the few people who testified in front of the Senate Banking Committee against that. But, the chairman of the Federal Reserve at the time, the president, secretary of the Treasury, they were all in favor of this. And my father said that if we go off the gold standard, it's going to lead to higher inflation, right? Gold prices are going to go up. And the Federal Reserve chairman and the secretary of Treasury said the opposite. They said that it was the dollar that was propping up gold. And if we went off the gold standard, the gold price would fall. That it was the dollar that was supporting gold and that we would actually have lower inflation going off the gold standard. So, everything that the Federal Reserve chairman and the Treasury Secretary chairman said would happen was wrong. And my dad got everything right.
Look, what happened in 1971 under Nixon wasn't some masterful genius stroke of economic strategy. It was the easy way out. Political cowardice, really. A total punt of responsibility. And by the way, we're still paying for it today. 50 plus years later. In fact, it's why we're in the mess we're in right now, with trillion-dollar deficits as far as the eye can see, record high government debt, and the dollar teetering on the edge of a confidence crisis. A lot of people think Nixon took us off the gold standard. That's technically not quite right. What he did was close the gold window. He defaulted. It was a default, and you can dress it up however you want. You can call it temporary, which he did, or call it a suspension. But let's be honest, the US had promised the world that dollars were as good as gold. Foreign central banks held dollars instead of gold because they trusted they could swap those dollars for gold at $35 an ounce anytime they wanted. That was the deal. The US gave its word. So when Nixon closed that window, he basically told every country in the world, hey, sorry guys, all those I owe us we gave you for gold? Yeah, well, turns out we can't pay you. So tough luck. It was a giant bounce check, a sovereign insufficient funds notice. Imagine if you had a checking account with your bank and you kept writing checks, far more than you had in deposits. And then when people came to cash them, you told them, oh, actually, I'm not going to honor that anymore. I'll just give you more paper instead. That's what we did to the rest of the world in 1971. But why did we get there? It wasn't Nixon who created the problem. The problem was created in the 1960s. Under LBJ, with the Great Society, the war on poverty, Medicare, Medicaid, ramping up spending on everything under the sun, plus the Vietnam War. We had guns and butter. We were spending like drunken sailors. The US government was issuing piles of debt to pay for all this, and we were printing dollars far beyond the gold reserves we actually held. It was inevitable that foreign central banks, France was the first to really catch on, would look at these massive piles of dollars accumulating in their vaults and say, wait a minute, the US is printing way more than they have in gold. We better cash these dollars in for gold before they run out. And that's exactly what started happening. The gold started flowing out of the US Treasury to settle these claims, and our reserves dwindled. Now Nixon faced a choice. He could have taken the responsible but painful road, dramatically cut government spending, end the deficits, jack up interest rates, basically engineer a massive deflationary bust to bring prices back down in line with gold. That would have meant a huge recession, bankruptcies, unemployment, all politically toxic. Or he could devalue the dollar. Just reset the gold peg from $35 an ounce to $100 or $200, effectively admitting we had printed way too many dollars. But that would have been incredibly embarrassing and would have destroyed confidence in the dollar overnight. So instead, Nixon chose the sleaziest, most politically expedient option. He defaulted. He closed the gold window. He told our creditors, nope, sorry, we're not paying. That way, he avoided the short-term political pain, but he set in motion the long-term destruction of the dollar. And predictably, we got exactly what my father warned Congress we would get. You know, my dad, Schiff, was one of the very few people who testified before the Senate Banking Committee in the 1960s, warning about what would happen if we went off the gold standard. He was practically laughed out of the room. The Treasury Secretary, the Fed Chairman, all the big shots assured Congress that if we dropped gold, inflation would actually go down. That it was the gold backing that was propping prices up. I mean, you couldn't make it up. Complete clown world. Of course, the exact opposite happened. Gold went from $35 an ounce to $850 by 1980, a 24-fold increase. Oil went from $3 a barrel to $30. That's not oil going up. That's the dollar going down. People love to say, oil prices exploded in the 70s. No, they didn't. The value of the dollar collapsed. It took 10 times more dollars to buy the same barrel of oil. Same with everything else. It's always the dollar losing value. And since then, the dollar has lost something like 98% of its purchasing power versus gold. Think about that. If you held a $100 bill in 1971, today it buys you roughly what $2 did back then. Meanwhile, an ounce of gold held its purchasing power perfectly. Actually, it's risen because trust in fiat currencies has deteriorated so badly.
Gold's just been around for thousands of years. And, gold is gold. Gold doesn't really change. What changes is the value of fiat currency. How much, of a currency do you need to buy gold? And when we had a stable monetary system, that was, there was no central bank. What we were on, gold was our money. The price was constant. The first Coinage Act in 1789 defined a dollar as a weight of gold. And basically, an ounce of gold was $20. That's what it was. $20, was 1 ounce. And when we created the Federal Reserve in 1913, it was still $20 an ounce. And it stayed 20 until 1933 when Roosevelt devalued. And now you needed $35 to buy an ounce of gold. So the dollar was now worth less gold than it was before Roosevelt devalued. And it stayed $35 an ounce until Richard Nixon was president. And he devalued the dollar a couple of times. And he left it at $42.22 or something like that. And then we said, okay, forget it. We're off. The dollar is no longer defined by gold. The dollar is not worth its weight in gold. It's just worth whatever somebody will pay for it. It's just free floating fiat currency. No longer has any tangible backing to it. And ever since then, you've need more and more dollars to buy an ounce of gold. Now you need 3,300 to buy an ounce of gold. But gold hasn't changed. It's the same ounce of gold. What's changed is the purchasing power of the dollar, fiat Federal Reserve note. And that's going to continue. I mean, we have massive deficits that are only going to get bigger, not smaller. For all the political hype of Doge, the Republican big, beautiful bill takes a debt problem and makes it worse. The deficits that were already big will be bigger as a result of this bill than they would have been had they never passed it.
Why?
Well, because they have tax cuts and spending increases beyond what was already scheduled. And so there's bigger deficits, so there's more money printing, and so dollars are going to lose value, and you're going to need more dollars to buy the ounce of gold. But I'd say that the entire move, probably over the last year and a half, where gold's gone from about 2,000 to 3,300, 50% increase in the price of gold, has happened with very little public interest. The public has not been buying gold. They've been buying Bitcoin instead of gold. The buyers have been mainly central banks, foreign central banks, who I think are a lot more sophisticated than the typical Bitcoin buyer. And I think that they're buying gold because they're selling dollars and they're looking for a diversification from their reserves. And I think they recognize that the dollar's value is going to decline, that its days as the reserve currency are numbered, they're not over yet, but they're coming to an end. And so they're preparing for a world where the dollar is no longer, the center of global monetary system. And so if you're going to replace your dollars, what are you going to replace it with? You buy euros, you're going to buy yen, you're going to buy pounds. I mean, all those currencies have their own issues. I think the most likely alternative for central banks to hold is gold. And so they've been buying, and I think they're going to continue to buy, regardless of price. But at some point, I think the public is going to wake up to what the central banks are doing and join in. And so that's going to send the gold price up even higher, when now you have, private investors, both retail and institutional, competing with central banks to buy a scarce quantity of gold.
So let's dig even deeper into where this is headed, because I promise you it's not back to normal. People cling to that fantasy. They think somehow we'll just go back to 2% inflation, mortgages at 3%, the stock market quietly compounding 12% a year forever, the dollar safely king of the hill. No. We're not going back there. We're on the edge of a systemic reset, and when that happens, the people who are holding tangible money, real money, will be the ones still standing. It's funny. I get calls from journalists who say, "Peter, don't you ever worry about being wrong, about gold not going up or the dollar not collapsing?" I tell them, look around. Have you seen the fiscal state of the United States? Have you read a balance sheet? I'd be terrified if I were not worried. If anything, I worry that I'm underestimating how fast this thing can unravel. And by the way, we're already seeing it. Look at what's happening with the U.S. Treasury market. For decades, treasuries were the most liquid, most trusted asset on the planet. Now, foreign ownership of U.S. treasuries is collapsing. Japan is selling, China is selling, even longtime allies like the Saudis are reducing exposure. Meanwhile, the U.S. government needs to roll over trillions in debt every year. Who's going to buy it? The American people? Maybe, but only if the Fed steps in and keeps interest rates artificially low, which means, you guessed it, even more money printing. This is why we have these phony markets now. The Fed tries to set the price of money, manipulates the bond yields, props up zombie companies. It's all artificial. The minute they stop printing, everything falls apart. It's like a circus clown spinning plates. You take your hand away, the whole act crashes. Except in this case, instead of broken dishes, we're talking about pension funds, insurance companies, entire banking systems. That's why gold is rising. People think it's about demand for jewelry. Come on. Gold goes up because people lose confidence in central banks and fiat money. It's a barometer of fear and distrust. Same with silver, which, by the way, is still probably the most undervalued asset on the planet. The gold-silver ratio has been completely out of whack for years. Historically, it's hovered around 15-1, sometimes 20-1. Today, it's been 80 or even 90-1 recently. That's an absurd gap. It will close. And when it does, silver is going to move violently higher. And we're seeing signs of that already. Look at the physical deliveries on COMEX. This is what nobody talks about on CNBC. Historically, futures contracts on COMEX settle in cash. Almost nobody actually stood for delivery. It was all just leveraged paper games. Well, guess what? That's changing. Starting last fall, we've seen massive standing for delivery, both gold and silver. In May alone, there were record deliveries. These are not retail investors buying 20 silver eagles on eBay. This is big money. Family offices, sovereign wealth funds, billionaires, quietly accumulating metal, taking it out of the system, removing counterparty risk. Because here's the thing, paper promises are only good as long as people believe they'll be honored. When confidence breaks, paper burns. That includes dollars, that includes bonds, that includes ETFs that say they have gold stored somewhere in a London vault you've never seen. That's why smart money is taking possession. You don't want to be standing in line with a worthless IOU if things get chaotic. And by the way, look at who's driving this shift eastward. China and Russia aren't dumb. They've watched how the US has weaponized the dollar. They've seen the sanctions. They've seen how the West froze Russia's central bank reserves. Imagine that. A G20 central bank woke up one morning to find $300 billion of its own assets confiscated. You think China didn't notice? That's why they're building alternatives. That's why the BRICS are meeting, setting up their own payment systems, launching the BRICS Bank. They want a monetary system that's outside Washington's control, a system that doesn't rely on the dollar or on SWIFT. In fact, at the last BRICS meeting, they explicitly said they're looking to settle trade in local currencies or commodities. Even gold. And Saudi Arabia is joining? Do you realize how huge that is? For 50 years, the petrodollar system meant every country needed dollars to buy oil. That forced global demand for dollars. It allowed the US to run endless deficits because there was always someone willing to hold those dollars. If Saudi Arabia starts accepting yuan, rupees, or gold for oil, that's the end of the petrodollar. The end of guaranteed external demand for dollars, which means all those dollars sitting offshore, in European banks, in Asian reserves, can come flooding back home. That's called hyperinflation fuel, because the dollars don't disappear. They just lose value as people try to swap them for something real. It's like musical chairs, but with burning chairs. You don't want to be holding fiat when the music stops. Now here's the irony. As this transition happens, the US government is still out there spending money like a drunken sailor. We just blew through $35 trillion in debt. Interest costs are exploding. Meanwhile, the political class in Washington can't even agree on budgets. They're too busy arguing over who can outspend the other. It's almost comical. Both parties are addicted to deficit spending. Republicans talk about cutting spending, but when they're in power, they cut taxes and keep spending. Democrats promise free everything. Meanwhile, the Treasury keeps issuing bonds, the Fed keeps buying them indirectly, and the dollar keeps circling the drain. Now, some people say, Peter, you've been talking about this for years. Why hasn't it happened yet? Well, crises take time to build. Look at 2008. The signs were there in 2005, 2006. It took time for the mortgage market to blow up. Same here. The cracks are obvious. Commercial real estate is starting to crack under the weight of higher rates. Regional banks are shaky. The treasury market is showing stress. Foreigners are dumping treasuries at record pace. Meanwhile, gold is creeping up, silver is surging, the pieces are moving, and by the way, there's a giant asymmetric opportunity here. You think the average person on the street owns gold or silver? Of course not. Most people are all in on stocks at nosebleed valuations or on cash sitting in banks that are one crisis away from insolvency. They're chasing meme stocks. Meanwhile, gold and silver are still tiny markets. When the stampede comes, it's going to be like trying to funnel Niagara Falls through a garden hose. Prices will have to explode to accommodate the surge in demand, which is also why I think the miners are one of the best asymmetric bets out there. Look, miners are notoriously volatile. They're leveraged to the underlying metal. They've been beaten down for years because investors didn't believe gold would ever sustainably go above $2,000. Now that it's pushing toward $2,400, they're starting to wake up. But miners still haven't priced in $3,000 or $5,000 gold. When that happens, the returns can be staggering. Same with silver. Silver miners are even more bombed out relative to the price of silver. If silver moves to $50 or $70, which is entirely possible once we break these technical levels, some of these miners could 5x or 10x. Not because they become better companies overnight, but because the leverage is enormous. Now look, I'm not saying back up the truck tomorrow. These things are volatile. You want to build positions prudently, but don't ignore the big picture. The dollar system is dying. The BRICS are building a new system. Central banks are buying gold like it's going out of style. The world is preparing for a monetary reset, whether people see it or not. And just to inject a bit of humor, I saw a meme on Twitter the other day. It showed Jerome Powell at the printing press, sweat pouring down his face, and the caption said, "Me printing money to pay interest on the money I printed, to pay interest on the money I printed." That's basically where we are, a giant recursive Ponzi scheme, and it only keeps working until confidence cracks. So yeah, protect yourself. Own real assets, own productive businesses, own commodities, own land. But most importantly, have a core position in gold and silver. Not ETFs, not promises, physical metal you control. Because in the end, gold doesn't default. Gold doesn't print itself into oblivion. Gold is no one else's liability, same with silver. And one last thing, keep some cash. People always think I hate cash. I don't. Cash is useful in the short run, especially if asset prices drop and you want to buy. But understand cash is not a long-term store of value. It's a melting ice cube. So hold enough for liquidity, but don't bet your future on it. Because look around. We're at the end of a long, unsustainable experiment in fiat money and zero interest rates. The party is ending. And when it does, the people who did their homework, who prepared by getting out of paper and into real things, they'll be the ones left holding wealth when everyone else is holding worthless promises. That's the reality. You can either face it now and take prudent steps, or ignore it and end up like every other bag holder in history, wondering where all your purchasing power went. And look, I'd rather have this conversation with you today, while things are still calm, than be the guy telling you, "I told you so," when gold is at $5,000 and your dollars are buying half what they buy today. So be smart, understand what's happening, get positioned, and when this all plays out, which it inevitably will, you'll be thankful you did.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.